Hi, Step Orange County is excited to be hosting Jerry Hesch on April 27th at 12 noon Pacific Standard Time. This will be an in-person as well as virtual presentation. We're excited to also be able to share continuing education credits, MCLE, CPE, CTFA, CFP, and California insurance certificates. So it should be an incredible opportunity to gain some credits, but also mostly to hear Jerry Hesch. Jerry Hesch is a consultant to other lawyers. He's a member of ACTEC, and frankly, his resume is so impressive and longer than I have time to share here. I encourage you to go to our website and look at Jerry's credentials. Very impressive. Jerry will be talking about non-grantor trust. Traditionally, it focuses on estate planning benefits, but he's also going to include a significant portion on income tax planning. So this will be an incredible opportunity to talk with Jerry and learn what he has to say. In fact, Jerry, give us a few words on what you'll be presenting on the 27th.
Okay. Yeah, most estate planners have always been using grantor trusts. And when you use grantor trust, all of the income has to be reported by the grantor. And what we're going to focus on is using non-grantor trusts for income tax planning that is not available with grantor trusts. For example, a non-grantor trust is a regular complex trust. And people say, well, a complex trust reaches the top bracket at $12,000. But it can conduit out its income to beneficiaries who are in lower income tax brackets, especially if you have beneficiaries who are young children or recently married. And so one of the things we're going to focus on is assignment of income to taxpayers in lower marginal income tax brackets. And if those taxpayers happen to be non-California residents, we can also eliminate California income taxes as well, or reduce the income tax burden. The other thing we're going to focus on is if I sell property to a non-grantor trust, I realize the gain, and if I take back the non-grantor trust installment note, I can defer the reporting of the gain under the installment method. So we're going to talk about how to use installment sales to non-grantor trusts so that the individual can end up, when they sell the property for cash, it's not going to be them selling the property for cash. It's going to be the trust that just purchased the property. And so the trust that purchased the property can have all the cash, and yet the gain reported on the initial sale can be deferred for another 15 to 20 years. And then we're also going to show you that there is a estate planning benefit to this, because on the estate planning benefit, it's really, you sold the asset for its current value. So it's still an estate freeze. Now, one of the difficulties is that everybody's so used to drafting grantor trusts that there's all sorts of traps that you have to amend your regular trust agreements so you can have a non-grantor trust, because too many people are so used to using the grantor trust form, they might inadvertently have a grantor trust, okay? Now, what is also interesting is all the Biden proposals that have caused all this consternation all have applied to grantor trusts. None of them apply to non-grantor trusts. So what this means is if all these provisions come in, the fallback will be to use the non-grantor trust for your income tax planning and estate planning, okay? And the nice thing is we're also going to show you how the individual, because they're creating because there's a non-grantor trust, the individual could be a beneficiary of that non-grantor trust. And we're going to, talk about that, because what most people are using, slats for their estate planning and worry, what if I don't have a spouse? So we're going to show you how a non-grantor trust can have an individual who sells the asset to the non-grantor trust and still be a beneficiary. Then there's a nice little thing that we're going to focus on. If I sell the property to a non-grantor trust, all I get is the interest on the note, and I don't get anything until the principal is paid some 20 years in the future. Well, what if I would like to get more cash? Now, there's an installment sale rule that provides that if you pledge your installment note as collateral for a loan, that's called an early disposition, and you have to report to the extent of the loan proceeds the gain. Well, there's a special exception in the Internal Revenue Code under Code Section 453A D that says if you sell farm property and defer the gain under the installment method, and you pledge the farm property and you pledge the note as collateral for a loan from the bank, the early disposition rule doesn't apply. So this is great for farm property. And those are the things that we're going to cover in excruciating detail. I just wanted to give you an overview. The key is estate planners have been so used to using grantor trusts that they need to be educated about how all the advantages of non-grantor trusts can be used and still achieve an estate planning objective. With that, I look forward to seeing everybody in Newport Beach at the Pacific Club. I hope lunch will be good because I'm looking forward to it. And we'll see you all on April 27th.
Thank you, Jerry. That's great. We are really looking forward to it. What a great topic, and the detail and the importance is phenomenal. So it'll be great to see everyone, you in person, and we'll have, like I said, virtual as well as in-person attendance. Thank you, Jerry.
Thank you very much. I look forward to seeing you in 2 weeks.
Thank you.